In this video, we will discuss what determines interest rates. Under a free market system, the interest rate on either a bank account or a government-traded debt instrument or a private corporate debt instrument would be determined by this kind of an equation. The interest rate R sub n, where n is the number of years to maturity, equals R star, the real risk-free rate, which in the past has been approximated by the Treasury bill rate, the U.S. government short-term debt instrument rate, minus the CPI, or the government's estimate of inflation, the Consumer Price Index, plus an inflation premium, which is the expected average inflation over the next n years, where n is the number of years to maturity on the debt instrument, plus a maturity risk premium, where MRP sub n is the compensation for taking on time risk. It is more risky to invest in a 30-year debt instrument than a 1-year debt instrument because you don't get your money back for 30 years and you don't know what will happen over 30 years. A company could go bankrupt, a government could be overthrown, etc. And this is sometimes approximated as N, the number of years to maturity, minus 1 times something like 0.5%, plus a default risk premium, based on an estimate of how likely it is for a corporation to default. These are generally determined by things like letter grades, where AAA would be an A+, the least likely to default. AA would be an A, the next least likely to default. A would be an A-, BBB would be a B+, BB would be a B, etc. And then you have high yield and debt instruments. So as we go down here, the default risk premium would increase, and then plus a liquidity premium. Liquidity premium is based on commonly the size of the company and how much debt it has. So a very big company has a lot of debt. If you own that debt, you can probably find somebody to buy it and you can sell it early. You don't have to hold it to maturity, whereas a small business loan, the bank that makes that may know about the small business. Nobody else might. It might be a very good, profitable small business, but it would be hard for that bank to sell it to somebody else. So that small business, even though being stable, might have a high liquidity risk premium, even though they would have a very small default risk premium. In most cases, only these first three apply to government debt, since most governments, like the U.S. government, would not default. They would just print more money, and the U.S. government has tons of government debt, so it is very liquid and regularly traded. Now, that would be for a federal-type government that could print its own debt. The state of New York, for example, could default on its debt because it can't print U.S. dollars, and there are also somewhat national governments like Greece, which could default on its own debt because it is no longer on its own currency. It is on the euro and it cannot print euros. So in those cases, these would be added to a government debt instrument. So I mentioned at the beginning, this equation is valid under a free market system. Those systems largely don't exist anymore because of central banks interfering in debt. For example, the U.S. Central Bank has now pushed the Treasury bill rate to almost zero, but inflation certainly is not zero. According to the U.S. government itself, inflation is currently around 4% a year on the CPI, and there are many people like those at shadowstats.com, some economists that analyze the way inflation used to be calculated, that believe inflation is currently around 8%. So if we were to look at the real risk-free rate, the T-bill rate is 0, the CPI is 4 to 8, so every year you would lose 4 to 8% of the buying power of your money if you invested in a T-bill. So the idea of delayed compensation for delaying consumption doesn't exist, again, due to governments interfering in the debt market and causing inflation. Common test type questions for this would be like the one below. Say, for example, the real risk-free rate is 3%, R star. Inflation is expected to be 4% this year and 7% next year. So to get IPN, we would need an IPN 2, and that would be I1 plus I2 divided by 2. R 4 plus 7 divided by 2, or 5.5% is our IPN. If the maturity risk premium is determined as shown above, well, this is a 2-year debt instrument, so we would take 2 minus 1 times 0.5% and get 0.5%. So if the maturity risk premium is determined as shown above and the default risk premium plus the liquidity premium is 5%, that would be the sum of these two, what should the yield on a 2-year corporate bond be? So we have 3% plus 5.5% plus 0.5% plus 5%, shown summed here, and we get 14% would be the yield on this 2-year corporate bond. Now, these kind of interest rates have not been seen since the 80s in the United States, but if inflation keeps popping up as it is now, it is certainly possible in the future, at least on non-government debt, to see these kind of interest rates again. What we have discussed so far is related to a normal or upward sloping yield curve, whereas the duration or maturity of the bonds increases, going in this direction, then the yield on the bonds increases, going in this direction, and the yield curve goes up. We can see this is the case both for government debt and private debt, and again, this is considered the normal situation. It is possible to have an inverted or downward sloping yield curve where short-term debt pays a higher interest rate than long-term debt. This was common in the United States in the 70s and early 80s. After Nixon had defaulted on the gold standard in the early 70s, the U.S. government actually made attempts to fight inflation. They would raise interest rates on the short-term basis, which then drove down the stock market, that they would then back off, cut the short-term interest rates, the stock market would go up, and the cycle would repeat. This finally ended under the administration at the Federal Reserve of Paul Volcker, who was appointed by Jimmy Carter near the end of his term. Paul Volcker drastically increased short-term interest rates, driving them up to above 18%, pushed the U.S. economy to a recession, where the stock market bottomed in '82, and people actually believed that Volcker would be successful at taming inflation. So we had short-term interest rates of 18%. You had long-term interest rates down around 12. The government at that point in time was just controlling the short-term rates, and people were happy to buy the long-term interest rates because that would guarantee them a 12% yield for the next 30 years, and they believed inflation would be below that, and that turned out to be correct. So this inverted yield curve did, in fact, stabilize the U.S. currency and led to a very robust U.S. stock market with the greatest bull market in U.S. history running from 82 to 70. As inflation is increasing today, something like this may need to be done in the future, but currently the Federal Reserve, rather than fighting inflation, is basically denying that inflation even exists. I thank you for watching this video.